I do understand for many people an ounce of gold is out of reach, and that's frustrating, and I'm very aware of that and sensitive to that. But $52, $60, even $100 silver is not out of reach for most. And I do think, as Rick Rule said, silver rewards infrequently but extravagantly, and we're now just seeing silver do what it does best when there's a gold bull market. I think the gold bull market is just starting. That's why silver is starting to do what it does best, that little speedboat that races past the juggernaut of gold when gold's in a secular bull market. I think a lot of investors who feel like they're missing out on protecting their paper money dying by having precious metals, they still can afford silver.
The current gold bull market, now around 735 days old, is showing all the hallmarks of a historic rally that could still have years to run. Historically, such cycles have lasted well over 1,000 days, and according to Matthew Piepenburg, this surge isn't just another market boom, it's a structural shift in global finance. The rapid move towards $7,000 gold is being fueled not by retail speculation, but by central banks, which are now accumulating gold as a strategic reserve to protect against currency debasement. Piepenburg describes this as gold reclaiming its ultimate role as the foundation of real money, signaling that the world is entering an era where trust in paper assets is rapidly deteriorating. He explains that global monetary authorities, particularly in the East, are quietly preparing for a post-dollar era. China has reduced its U.S. Treasury holdings by more than 27% since 2022, while central banks worldwide have collectively purchased over 1,000 tons of gold annually for reserve diversification. This massive accumulation is not random. It reflects a deliberate shift toward a gold-linked trade system where settlements are increasingly backed by tangible assets rather than promises. Piepenburg points out that a U.S. return to any form of gold standard would first require a full audit of its reserves, as rivals like Russia and China may already possess far more than they publicly admit. He emphasizes that this new gold movement is part of a broader de-dollarization trend that's gaining unstoppable momentum, reshaping how nations define and store value. In this changing landscape, silver is also emerging as a critical piece of the puzzle. Often called the poor man's gold, silver is poised to benefit even more dramatically as monetary confidence continues to erode. Industrial demand, combined with its historic monetary role, could drive silver's price to surge alongside gold, narrowing the gold-to-silver ratio back toward its traditional levels. Piepenburg stresses that this is no longer just a gold story, it's a full-blown reset of the global monetary order. As faith in fiat currencies collapses under the weight of debt and inflation, both gold and silver are stepping back into their natural positions as the true measures of wealth in a system that's finally being forced to confront reality. Now, we present the clips from Matthew's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
This was a conversation I had this morning. I was my advisor at Von Greyer's. I was interviewing, it was Alistair MacLeod, and we were off the record just talking to ourselves. What are the things we can do? In addition to the things about being honest, having austerity, cutting spending, we'd have to have sound money, and to have sound money, you'd have to go back to a gold standard, right? And that is I don't think that'll ever happen, because if you go back to a gold standard in the US, that's a chaperone. That's like when you're a teenager, you don't want your parents home at Friday night at 9, 10 p.m. if you're having a party. You want to keep the party going. You don't want the chaperone. If you bring back a gold standard, well then, what does that mean? It means you can't deficit spend, you can't print money anymore at will to monetize your expenses. It would force you to cut your spending. And I don't think a lot of sovereign nations want to do that. Even China doesn't want to go to a gold standard yet. If the US went to a gold standard, that would be sound money, that would be smart, but that would force massive austerity in the short term because you wouldn't be able to spend for everything you want. So, but what central banks in the East are doing is they're doing that indirectly. They're not going to a gold standard, but they're seeing a new world where gold will be a net settlement currency. And that's what the BRICS have already foreshadowed already in the last few years. They're seeing a world where gold's going to play a far more important part than the US Treasury. And if the US went on a gold standard, that'd be fantastic. But then the question is, he who has the most gold wins. And look, we haven't had an audit. There's been crickets about the audit. That was big in the first year after the election, that we were going to audit Fort Knox and to see who has the most gold. I don't think, and I don't think I'm being alone in that. The USA, I think, had 22,000 tons of gold in the 40s. We had 9,000 tons by 1971. We're supposedly have 8,100 tons today. First thing we'd have to do is audit the actual gold. Do we really have the gold we say we do? Russia probably has at least 12,000 tons. They're not even listed on the World Gold Council's report. And China has significantly more than 3,000 tons. And this is what Kissinger warned. He who has the most gold wins. Let's not revalue back to gold until we know who has the most. And I don't think it's the US. So there's a lot of ifs and buts. But going back to a gold standard is unlikely. It would be one more thing I would try to do if I were in charge, but that would be hard to do and get elected and stay elected because you'd have to cut spending dramatically. So we're really in a pickle. But eventually the world's going to not necessarily have a gold-backed yuan or a gold-backed ruble tomorrow. That's a red button option they would have. I don't think China wants to push that button because that would crush America at a time when they still need America to some extent. I think they're waiting for America to implode itself and then push that button later. But we don't have the most gold. That's my strong opinion. I would love to see an audit of our actual gold that was promised to us, but like so many things, that hasn't happened. And even Egan and I were talking this morning. Be careful what you ask for when gold gets to 4,000, 5,000, 7,000. That's great for us who've had the foresight to understand sound money and gold as an insurance against fiat money. But it's very bad for the rest of the world. But what we're seeing with gold isn't just another commodity trade. This is a systemic change in global markets. It's more than a commodity trade. It's a monetary metal becoming the new strategic reserve asset beyond the US Treasury. And for that reason, central bank demand is clearly the key driver behind these gold prices. It doesn't even include retail demand, which is barely catching on. I mean, gold is still 5% of global allocations, or excuse me, 0.05, so 0.5%. The historical average over the many decades has been 2%. It reached 8% in the 1980s. So gold hasn't even begun to hit the retail markets. It certainly has in China. ETF purchases in China have gone from 15 billion last year to 60 billion this year. That's just the retail markets. But US markets have not caught on. Even the Morgan Stanley recommending 60-20-20 now instead of 40% bonds is 20% gold. That's remarkable for a whale like Morgan Stanley to finally confess that. But the average man on the street, for many reasons, can't afford it or hasn't thought about it or hasn't been told to that by their wealth advisors that gold matters. They've been told for 25 years that gold is too volatile, where it's outperformed the S&P for 25 years and even the last 5 years. So there's a lot of catching up to do by the retail side, but I think the fact of the matter is that it's the central banks that are driving that should be more concerning because we haven't even gotten into the retail trade. And when that happens, gold's only going to go higher. Again, I'm not saying gold goes up only in a straight line. But this is an historical shift, not just a commodity cycle for gold in the next year or two. This is a seismic shift, and gold will continue to inch its way up higher and higher to levels that, again, when you and I first started talking, Dave, I think it was at 1,600 and people were saying it was too expensive. Or maybe at 1,800 it was too expensive. Or at 2,500 it was too expensive. At 4,200 is it too expensive? And I could tell you many stories about why that's wrong thinking, but I understand why it is. But it's again, you could say I'm just selling my book. I'm a gold executive. Of course, I'm saying this. But all of us who understand precious metals know that this is not the end of the gold price. This is just the beginning. And I only wish more retail investors understood that because it is hard for them to pay $4,200 for an ounce. Certainly, there could be a pullback. I was talking to Henrik Zeeberg back in February in South Africa, and his big thing was markets are going to top. There'll be a 30% pullback in gold. At that time, gold was at 2,900, so no one was buying. Well, even think about that. There was no pullback. Now we're at 4,200. If there was a 30% pullback, which I don't see, but even if there was, gold would still be higher than it was in February. So if you're waiting for that pullback to buy in, you're playing with moving goalposts. If you're buying gold as long-term preservation against dying fiat money, I do understand for many people an ounce of gold is out of reach, and that's frustrating. And I'm very aware of that and sensitive to that. But $52, $60, even $100 silver is not out of reach for most. And I do think, as Rick Rule said, silver rewards infrequently but extravagantly, and we're now just seeing silver do what it does best when there's a gold bull market. I think the gold bull market is just starting. That's why silver is starting to do what it does best, that little speedboat that races past the juggernaut of gold when gold's in a secular bull market. And that's what we're seeing. And there's a lot of reasons why. Now, again, I was talking about this with Alistair this morning. Silver is massively undervalued, as all commodities are. Really, even pork bellies, wheat, and oil is undervalued and measured against gold. We don't see right now at 80 gold silver ratio, the kind of compressed gold silver ratios we saw in 1980 or 2011 was at 15 or 32. But I do believe that silver is going to be, when you look at it at its all-time high at 50 prior to these current highs, if you were to inflation adjust those prior $50 highs, gold should be at least at 150, which I definitely see it going to that. So if you're patient and you're buying silver for the right reasons, not as a day trade to see what it does in the next 6 weeks, if you hold it, it will give you that extravagant, though infrequent reward. And I think a lot of investors who feel like they're missing out on protecting their paper money dying by having precious metals, they still can afford silver. We have a lot of clients right now who have the means to buy both gold and silver who are buying silver because they see a massive price appreciation in it. I think for retail investors, that's a huge play for them. There are clear supply deficits in silver. The entire silver market is half of NVIDIA's market cap, so it doesn't take a lot of new demand to push the silver price up. And the ability to manipulate silver on the COMEX or LBMA markets just isn't what it used to be 5 years ago when there was legalized price fixing in the COMEX or London exchanges. Look, there was 80,000 silver contracts short on the COMEX recently. That was a massive short position, and still silver was able to peak through. And the COMEX is running out of silver to continue to make those price manipulations. The London float of available ounces is only about 155 million ounces, and that's a day's worth of trading. So the paper manipulation, the cartel in London and New York is breaking. That's very good for silver as well. In the past, there was the manipulation on the futures contracts on the LBMA and COMEX markets, and then there was a huge dumping. First the shorts, then the dumping. That happened in '81 when Gordon Brown was selling gold at 270 for his country, which is a disaster. But again, you've got a 45-year cup and handle, on the technical side for silver. You've got a clear supply side deficit on it. You've got a clear momentum trade in its favor, and you've got it massively undervalued in terms of gold. So I think silver is an incredible fat pitch for people who want to get in the precious metal space who can't afford $4,200 gold right now.
Matthew Piepenburg explains that gold has now broken free from its traditional inverse relationship with the US dollar, signaling a major change in the global financial landscape. He notes that gold's current strength is no longer about short-term currency fluctuations, but about the dollar's waning credibility as endless money printing and debt monetization undermine confidence in fiat systems. According to Piepenburg, central banks, particularly in the East, have recognized this reality and are steadily replacing U.S. treasuries with physical gold, viewing it as a more stable and trustworthy reserve asset. This movement, he emphasizes, doesn't signal the outright collapse of the dollar, but rather a historic revaluation of its role in a world shifting toward sounder forms of value storage. Gold's historical record during periods of currency debasement continues to reinforce its reputation as a reliable preserver of purchasing power. Studies show that gold typically rises when real interest rates fall into negative territory, as investors seek protection from inflation and currency erosion. Conversely, it tends to lag during times of high positive real rates. Piepenburg underscores that the current environment of suppressed yields and mounting fiscal deficits fits the classic pattern for a prolonged gold bull run, one that reflects not just speculative demand, but a deeper global realignment of trust away from paper assets and toward tangible value.
You can pick statistical windows. You can look at periods where the dollar is strong and gold is strong, or the dollar is weak and gold is strong. I mean, gold is decoupled from the dollar and the world reserve currency and fiat money. But look, the dollar is an important theme when you're understanding precious metals, and the dollar is world reserve currency, so it's the most important currency to talk about, not just because I'm an American or just because I'm based in Europe. I'm not just focused on the dollar because it's my currency. It's a very important global currency. And because the dollar is used to monetize unsustainable debt, it has to be debased. When the M2 money supply is expanded, when central banks like the Fed print money, and when banks extend credit, that increases the money in circulation, and that's an inflationary force. It's a debasement force. The dollar is just being diluted like a beautiful glass of wine with lots of mineral water being tossed into it quarter after quarter. So the dollar gets diluted, but because it is the world reserve currency, because of the milkshake theory and that big straw-sucking sound from the rest of the world, there's still demand for it. The inflation can be exported as it's been for decades, but at some point the jig is up. And again, when you look at the dollar, it's only being debased because it's being used to monetize debt that's gone out of control. So the dollar and the debt and precious metals are all kind of in a circular loop. And again, this is just history. David Hume, the Austrian school, Thomas Gresham from the 1500s, Adolf Thiers in the 18th century, Robert Triffett in the 1960s, Charles Goodhart in the 70s. It's certainly nothing new. This is just a cycle. The current headlines confirm that the dollar is being debased. The BRICS de-dollarization, the DXY, central bank since 2014, net stacking gold and net dumping U.S. Treasuries. The petrodollar moves outside of the dollar. The COMEX fanatics and the gymnastics there. The BIS making gold a tier one. The IMF talking about gold in 2021, and 3 years of central bank gold stacking at over 1,000 tons per annum. This is the first time since 1996 that central banks hold more gold than U.S. Treasuries. And of course, even Judy Shelton is talking about it. Morgan Stanley has a 60-20-20 now allocation, Mike Wilson. The desperation of the Genius Act. These are all signs of a dollar in decline, or a dollar being pushed to the side in favor of a better strategic reserve asset, a better store of value globally, central bank-wise, and even at commercial bank levels. The dollar is just slowly but steadily being replaced by physical precious metals like gold. And in the devaluing of the dollar is nothing new. We did it in 1933 when FDR, in an executive order overnight, revalued gold from $20 to $35 an ounce. It's a 69% devaluation of the dollar. In 1971, when Nixon jumped off the gold standard, within 5 to 10 years, the dollar lost 90%. It's lost 99% since measured against gold since 1971. In my lifetime, the Plaza Accords in 1985, we devalued the dollar again. So devaluation, debasement to monetize debt isn't a gold bug case. It's an historical confirmation. And we see that it's affecting the markets. It's certainly affecting the gold price and the silver price. And it's really chapter 2 in a long, long novel of currency debasement to monetize debt. And I don't think gold's going to get any lower. It doesn't move in a straight line. Believe me, there can be retracements. I've had this debate with Brent Johnson, Henrik Zeberg, not declaring victory because the DXY is not at 100 yet. And there could be a last dance for the DXY, which we can talk about. But the dollar is simply losing purchasing power because it's oversupplied, overextended, and less trusted and less credible. Certainly on a relative basis, when you talk about the DXY versus other currencies, it's still the strongest horse in the glue factory for so many reasons. Because of its role in FX reserves, because of its role, it's 80% of global trade finance, it's $13 trillion in global debt, even if it's not due to U.S. banks, is in dollar denomination. And there's massive euro-dollar demand for the dollar outside of the U.S. and over 90 trillion FX swaps. So the dollar is still king relative to other currencies for now. But what's happening is that the dollar, and because of the dollar and the U.S. Treasury are so linked, and because the U.S. Treasury is so overissued and distrusted and weaponized since 2022, that was a turning point. The world is looking for a safer store of value. This term of art that we've been talking about for years is now making the headlines finally. They'd rather save in something that holds its value and spend in local regional currencies or fiat money. And that's why they're choosing gold, not just because the BIS told them to, but because they understand history too. If you and I can see these trends, believe me, the central banks of the East, and certainly in China and the BRICS, see it as well. And again, we're not seeing the death of the dollar or the end of the dollar. We're just seeing a repricing of the dollar and a slow loss of its hegemony. Again, this goes from the de-dollarization themes of the last 2 years to now the headlines making the gold market so popular all of a sudden. It's been clearly on our mind for a long time, but this is now history coming to its fourth turning. And the dollar will still have a role. It just won't be priced in the same way, traded in the same way, trusted in the same way, stockpiled in the same way as it was for decades before. And we're seeing that everywhere in the headlines now. It's not just a gold bug case. First of all, it's not just a slow realization that America has a debt problem. It's been an obvious realization, just ignored for years. It's now just becoming exponential. You can't ignore it because the citizen on the street feels it, and we'll talk about that. But if you just look at the math of debt, actually, debt to GDP in the U.S. is much higher than 99%. It's over 120%. And as David Hume said in the 1750s, when you cross the 100% debt to GDP Rubicon, growth mathematically slows by a third. This is a math reality. You're going to slow growth. You can't grow your way out of this debt crisis. When I was born, debt to GDP in the U.S. was 38%. So this is a massive move. And we've seen the cracks in the ice on the debt crisis. This was as clear as day to me in 2019 when I wrote Rigged to Fail, when we had the repo crisis. In March of 2020, we had a massive sell-off in U.S. Treasuries during the COVID hysteria and the COVID fall in March. And then in 2022, the UK had the gilt crisis. 2023, we had a banking crisis, but that was a US Treasury crisis. That was a credit crisis. In 2025, in April, we had a tariff crisis. No, it was a bond crisis. So again, the debt reality has been open and obvious for years. The politicians are just starting to see it, and the commercial bankers are starting to recognize because their clients see it. And the solutions aren't really good scenarios left. You can't bring debt to GDP down unless you cut entitlements defense, and you can't do that politically and survive. Entitlements defense and interest expense on our debt used to be 65% of our tax receipts in 2016. It's double that today. So what does the U.S. do? Can it default? No, although it constructively defaults when it has negative returning yields, which they do if you measure inflation correctly. We're having a negative returning yield across the yield curve. So that is a constructive default, but it's not an open default. So the only real option is to inflate it away. As Larry Lepard says, you can't taper a Ponzi scheme. So we're going to just inflate away our debt, debase our currency, lie about the inflation rate, have negative returning yields on our entire yield curve. And that's financial repression. When you're getting a negative return on Uncle Sam's IOU, that is constructively a default. We just don't call it that because we lie about the inflation rate. As far as you're saying, how does that affect the citizen on the street? You know, you and I have had this conversation so many times. I mean, look, I think the definition of a recession is another thing that we've talked about. I think we've been in a recession since 2022. You can look at the Psalms rule, you can look at the yield curve since World War II, you can look at the Conference Board leading indicators, you can look at the Labor Department data, year-over-year auto sales. I mean, the list goes on and on. BLS non-farm payroll jobs, downward revision of almost 1 million jobs. That was worse than 2009. 2021 saw 800K up, now we've lost all that. The delinquency rates are at 13-year highs on private credit. Private credit scores are dropping at historical levels. 53% of U.S. companies are showing negative profit margins. They're saying due to tariffs. Manufacturing is flat. Labor participation rate is 62%. That means half the population is paying for another half that isn't working. Private sector data, because now the BLS is shut down, whether you love them or hate them. I'm not a big fan of them. Trump fired the head of it for telling bad news. But now we're looking at ISM, Challenger Gray, Christmas, ADP, payrolls, et cetera. These are the private sources of information we can't get from the shutdown government. But we have a net loss of 32,000 jobs in September, and planned hiring is down 58% from last year. And Walmart's predicting a worse Christmas season than 2009. So again, I'm not making this stuff up. These are signs that Main Street is suffering, not because they're all unemployed, but because the purchasing power of their dollar is weaker. Their inflation number that is telling them that inflation isn't so bad is a lie to what they're feeling in their actual costs. And again, the government is giving you an IOU that is actually losing money to inflation. They just don't give you the actual inflation data. That's a known truth on Wall Street. It's now a felt reality on Main Street. So these are just all facts, David. It's not good when the dollar loses value and wages don't keep up with that debasement.
The coming years may mark one of the most dramatic transformations in global finance, as the world moves steadily toward a new era defined by tangible value and away from decades of debt-based expansion. The slow but deliberate retreat from U.S. dollar dependence is reshaping international trade and reserve management, creating the foundation for a system where gold once again stands as the ultimate arbiter of trust. History has shown that when paper currencies falter, gold reclaims its position, not as an alternative investment, but as the cornerstone of stability. This unfolding shift may soon redefine how nations measure wealth, settle debts, and safeguard their economies. If current trends continue, the transition toward a gold-centric framework could accelerate faster than most expect, especially as global confidence in fiat systems continues to erode. The rise in central bank gold accumulation, the surge in physical demand, and the quiet adoption of trade settlements outside the dollar all point to an inevitable rebalancing of power in the monetary order. Could we be witnessing the birth of a new global standard built on real assets rather than paper promises? Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution.